Today we're going to talk about option and corporate finance. We will go over option terminologies, payoffs, profits. We will discuss core parity, Schole, and binomial models. Lastly, we will talk about applications in corporate finance. There are two types of basic options. One is call option, one is put option. Call option will give you the right to buy underlying assets at a pre-specified price we call strike price or exercise price. Depends on type of option, we may have the right to do on or before the expiration date. Put option have the right to sell the stock or assets at strike price on or before expiration date. Option contract include strike price, which is the agreed-on price when they exercise options. Option give you the rights and at a cost. The cost of option is called option premium. That is simply the purchase price of options. You can buy options or sell options. The buyer of the options is in a long position, while the seller, the option writers, is in a short position. European option is more strict. It can be only exercised at expiration date. While American option give more flexibility, you can do the exercise option on or before expiration date. When you exercise the option today, result in positive cash flow, we call option is in the money. If negative cash flow, we call options out of money. If the break even, we say it's at money. So if you are the buyer, if you own the options, then you may want to exercise only when the options in the money. As you paid to buy the options, you may walk away when the options is out of the money. Let's look at one by one. So this is the basic call options. The buyers in the long position, you paid the premium $14 to get a call option. The strike is set at $80. So if we look at the payoff, which is solid straight line, the option is in the money when the stock price is above the strike price $80. The option is out of money when the stock price is below strike price. So that's a payoff. The broken line is a profit, where we subtract option premium $14 from payoff. So then the stock price has to be a bit higher. In this case, 80 plus 14, $94 to break even. Means the option is at money in the profit. So the option buyers buy the option hoping the stock price will go up. So they predict or bet the trend of the stock price movement is going up. The call option writers is in the short position. So they sell the call options because they believe the stock price will not go up. Instead, they believe stock price will go down. They sell the option and they received $14 option premium upfront. So they are able to keep $14 if the call option is always out of money. So nobody call in and exercise call options. So in terms of payoff, which is the solid line, so call writers keep $14 as long as the stock price is below $80 strike price. So they start lose money when the stock price go up as the call buyers start to call in stock and exercise call options. As you notice, the loss for call writers could be unlimited. So why the call writers want to sell call options? Because they believe the stock price will go down. Now take a look at the put option. For the buyers in the long position, they paid option premium and they own options. For the put option buyers, they are betting stock price will go down. Okay, so put option is in the money when the price go down. Let's take a look. The strike is $80. Suppose the price finish at 50. So then the put option is in the money. Why? So you are able to sell the stock at $80 according to the put option contract strike. The cost of providing a stock is $50 at that moment. So you make $30 payoff. So what is the maximum payoff? As stock is 80, so the maximum payoff will be $80 because the minimum cost of the stock is 0. So that is your maximum profit. When the put option is out of money, you simply walk away, lose the premium you paid for put option. The put option writers, they are in the short position, so they sell the put option, they receive some premium upfront. So why they sell the put option? Because they believe the price will go up. So if the prices go up, the put option is out of money, so they are able to keep this premium. So if the price go down, the put option is in the money, so they will lose some amount. If the exercise price or strike price is $50, so the maximum amount they will lose is $50. Now I'm going to ask you to read the option quote. So this option is based on the Facebook. On August 17, Facebook closed at $173.80. So this is the option terms for a specific one. So there have many call options based on Facebook and have different expiration date, different strike prices, so on. So we only pick one of them. So the Facebook ticket number, August 2018 160 call option. So let's look at the detail. The option premium average is $14.42. So you have option bid ask price. The strike is 160. Expiration date is August 24. So you are able to figure out the basic information according to the option quotes. One thing I need to call your attention is option is based on underlying 100 shares of stock. So each option costs $14.42 based on 100. So that's option you're going to pay $14.42 times 100 plus commission. There's another example I want to take a look and practice to figure out the basic information according to the option quotes. Next, we're going to talk about 3 different ways to figure out option value. One is protocol parity, second, the Black-Scholes model, and also binomial model. Both protocol parity, Black-Scholes model is based on European call option. Do you still remember that European option we can only exercise on expiration date, not before? Binomial model allow for the flexibility. You may actually exercise before expiration date due to the structure of multi-period procedure. I'm going to talk to you a very popular strategy. This is one of the basic insurance strategies used in option for the hedging risk. So this is called protected put. Protected put is based on 2 things. One is a stock, the other is a put option. So you're going to own both a stock and a put option. So you long position in these 2. Suppose our strike is 90. So if we put them together, the protected put has a very interesting payoff, which is they are guaranteed at strike price when the stock price finishes at lower than that, but they still enjoy the upside benefit when the stock price goes up. Let's take a look at one example. The strike is 90. Let's look at 2 cases when the stock finishes below or above this 90 price. When stock price is below 90, the stock was $87. The put option is in the money when the stock price is below 90. So we are actually getting $3 payoff. Put them together, the total payoff is $90. If the stock price finish above 90, 94, then the stock is worth $94. The put option is out of money because it's too high. Put them together, the total payoff equal to stock price 94, right? So you will have something like this kind of payoff. So what if the cost of stock and the cost put option, for example, is say $80 and $88? So how much payoff? So we're going to subtract cost then. So the net profit, $2, $6. I have another example for you to practice. Okay, figure out the stock price, put a stock payoff, and total payoff, net profit. So this is strategy 1. You could have a stock and the put option. You achieve such interesting payoff. Another way to achieve the same payoff is using a call option plus a zero coupon bond, with the face value equal to a strike. If you put them together, as you see, it's shifted and have identical payoff as the one through the protect put. So now imagine, I promise to always pay you same amount of money in the future if you buy A or B. Then how much are you willing to pay for strategy A or B today? Right? If they promise the same amount of cash flow in the future. Same thing, right? Same thing. Okay, so that's why we derived the first interesting valuation relationship, put call parity. The put call has this relationship because cost of the first strategy must be the same as the cost of the second strategy. Why? Because they promise same payoff in the future. So the first strategy we have a stock plus put option. Second strategy we have a call option plus the present value, how much you pay for the zero coupon bond. So the strike is E or X. So we will use a continuous discount factor, natural E, raise power to R times T. Okay. So this continuous discount factor compared to a discrete discount factor where we have 1 plus R to the power of T. So this is the continuous discount factor. This is discrete. Let's take a look at one example. A put option expires in 6 months. Strike is 45, sell for 480. Stock currently priced at $41, risk-free 3.3, and compound continuously. What's the price of call option? So we will lay out the call parity. The stock is $41. Put option sell for $4.80. Strike is 45 or exercise is 45. We use a continuous discount factor, the natural E, raise power at 3.3, discount rate times T, 6 months. So we don't use months, we use number of years. Okay, so we convert 6 months to a year, which is 0.5, plus C. That's the price of call we want to figure out. So then we figure out a call price $1.54. So this is the first valuation model. We could infer put price or call price from call parity as long as we know one of them. I will ask you to pause a moment, take out your pencil and calculator, and try this one. Option value depend a lot of factors. We have total 5. One is strike price, time left to maturity, the stock price, risk-free, and volatility. Time to maturity has a positive impact in both call and put price. Why? The longer time you waited, the more chance you will hit put call price option strike price. So because option in the money will hit right above or below strike. So same thing, the volatility. More volatiles help us to hit the strike level. We don't like something flat where there's no chance we're going to hit the break, hit the strike. Take example of a call option price. If you set strike price instead of say 50 to 100, so your option is in the money when the stock price hit above the strike. So raise the strike price, make the call option harder to be in the money. So this is going to be a negative impact in call price. Take example of call option, the stock price. If the stock price finish at say 200 versus 100, it's easier to be greater than, for example, stock price is 80. So the higher the stock price finish up, the better, the higher you're going to be in the money. Risk-free rate talk about opportunity cost. For example, for call price, if the option expires in 6 months, so we could actually exercise 6 months later. So during 6 months waiting period, if the interest rate raise up, so you are going to save more interest payment from holding these cash flows. If we put them side by side, okay, and we notice the impact. So that's going to be the 5 factors lead to our Black-Scholes model. So I'm going to pause a moment. Before we go to Black-Scholes model, I'm going to introduce your third valuation model first, which is binomial model. So both Black-Scholes and Parity based on European option, not American option. So American options you may exercise anytime, before or on expiration date. So we could only say so much about the boundary, such as the call price can never be greater than the stock price, right? Or call price can never be less than 0, okay? If the underlying stock is 0, call is worthless. Okay? So these are just the basic, the rough thing we can claim American option. One of the interesting approach is to use binomial model. So build multiple period, and each period the stock could have 2 possibility, go up or down. So only 2 state. So that's why we say binomial. But as time goes by, we see we have actually more possibility, different range of the price. So the model is based on two securities. One is stock, one is bond. The stock could move up or down, and the bond own a fixed rate of investment. Let's take a look at one example. The initialized stock price is 50. They may go up by 10% or go down by 3%. So we figured out stage 1 next period. In the up state, the price go up to 55. In the down state, price go down to 48.50. Based on the rate of investment, 6%, interest rate 6%, the bond is going to move, increase to $1.66 next year. Now, how do we do the call price or price based on binomial model? 2 things. After we figure out the stock prices, this is stage 1. Stage 2, we're going to figure out the payoff for the options. So stock is 50. We compare 50 with stock price next period. So for the call option, if stock is $50, which is greater than strike, means call option in the money and payoff is $5. when the price finish below 50, so the call is out money 0. So if we have a steep price, we can discount this payoff 2 times 0, QUQD. So this is just one way of doing that. We go to the actual number later. Same thing for put option. We compare stock price next period with strike price 50. For put option is in the money when the price is below strike, below 50. So put options out the money when the price go up to 55, but make $1.50 when the price go down. Again, if we know how to value this payoff next period, we can get the price of the option and put option today. So that's two step. Step 3 is we're going to use these formulas here. Based on this up or down, okay, based up or down, all these interest rate and stake price formulas, we figure out QUQD are these numbers. So I want to call your attention, this is not 1 plus I. It's not a discount factor. Okay, it's called stake price. So now we can plug in the stake price into this relationship and price in the call option and put option. So the call price is $3.27 and the put option is 44 cents. To summarize, to do one period binomial model, so what you want to do is first predict the stock price of next period. Then according to stock price, figure out the payoff of call option and put option. Then use input information, figure out the stake price. Lastly, pricing call option and put option. Okay, so I summarize this solution together in one slide. I will ask you to take a moment, pause, and take out your pencil and calculate, practice this one period binomial model. So this is only a simplest example. You may extend to the one period model to multiple period model. Then we will figure it out. We do similar thing once we figure out the payoff compared to the strike price and do the stake price and the discount one by one, figure the option price one by one. So then it gives you a lot of ideas when you want to exercise the options. So lastly now, let's discuss the Black-Scholes model in detail. So Black-Scholes model again is based on European call option. It's not American option. So you only exercise on expiration date. The call option is based on the 5 inputs, and we will first figure out D1, D2 according to formula. Then we use a normal distribution function to find the probabilities. So this is for a standardized normal distribution. Okay, how likely you have probability less than D. Okay, so the best way to find out norm and D is use Excel function norms dist. Notice they have different type of normal distribution functions. So this one is standardized. The one has with the S in the middle. We also will provide you use some table to look up the D and ND1 where we have some approximate numbers. Let's take a look at one example. A 6-month call option on Microsoft. Strike is 150, current stock price 160. Risk-free is 5%. Underlying assets volatility deviation 30%. So let's figure the 5 input. We have T. 6 months is half year. We have strike or exercise is 150. We have stock 160. Then we have risk-free 5%. We have standard deviation 30%, right? So our job next is go to D1, D2, use 5 input, figure the D1. Based on D1 and sigma T, figure D2. Now we go to Excel. So I calculate D1 and D2 for you. We need to find out ND1 and D2 use Excel function. So if you click on Excel icon, so you were able to see how we figure out that D1, D2, and D1 and D2 and the call price. So for once we know in D1, we will type in equal norms. Remember we have S in the middle, norms dist, and we just simply refer to the D1 because already standardized. So that will give us in D1. Same thing we can find out in D2, right? So plug in Black-Scholes model call price function, we got call price, option call price. The main application for Black-Scholes in the corporate finance setting is view the levered equity as a call option. So based on the underlying asset is the total asset of the firm, the strike is set at the payoff of the bond. The idea is that when the company is doing well, the total cash flow is greater than the amount of debt, the face value amount of debt. So stockholders is going to, just like call option, keep the company, pay off debt. But if the company is not doing well, they don't earn as much money, so finish below that. So they just walk away. They just dump the whole firm's assets back to debt holders. They claim bankruptcy. So they walk away, leave assets to debt holders. So we're going to treat this stockholders' value stock as the options call price. Okay. We need to figure out 5 things, right? We need to strike price, stock price, risk-free, standard deviation T. Okay. So strike price is the face value of debt. Okay, T is the number of years for debt maturity. Risk-free, sigma is underlying firm's standard deviation as the firm's assets. So we're going to discuss 2 applications. One is a merger acquisition. The second is capital budgeting. Let's take a look at one example. So the S is market value of assets, strike is face value of the bond, standard deviation is the underlying asset return volatility, risk-free, and time to maturity. So company owned for company A, B, so this is before merger, this is after merger. Company A, the total amount bond is 18. For stock, the company assets was 40. The standard deviation 40%. Risk-free 4%. These bonds do mature in 4 years. Similarly, we get the stats for the company B. The merger acquisition, the premium is showing in reduced standard deviation in the underlying assets. Okay, so which will increase the total firm's value. So we just use the Black-Scholes model 3 times. Okay, figure out what's the market value of equity based on these stats. Right, we are treating the equity value as the call price. So you can click on Excel, which basically we will just use those inputs, figure out, put into our Black-Scholes model template to figure out the D1, D2, and D1 and D2. Then use the Black-Scholes model, figure out the call price. So how much market value of debt? Just use total firm value here, 40, 15, 55. Subtract the equity market value. So what's left is market value of debt. So I'm going to ask you to take a moment and practice these questions. So the merger deal, if you have already Excel template to work out how to figure the Black-Scholes call price, once you figured out the input, things will be easier. You just have to repeat for each of the companies, A, B, or before, after. Okay, so here I give you some answers, but you do want to try by your own. Another application option in corporate finance setting is the capital budgeting examples. Suppose you have a different project with low NPV, product with high NPV, and they may differ in terms of the risk. Then which one will bring in more money to equity holders? So again, we treat stockholder value as options call price. We have to figure out 5 inputs, use Black-Scholes model to figure it out. So the market value of assets $40 million. Face value of debt 25. Debt mature in 5 years. Asset return standard deviation 40%, risk-free 4%. So we have all these 5 input informations. With the high NPV project, the firm value will increase by 3, and with low NPV project, firm value increase only by 1. The high NPV project is with low risk, standard deviation 30%, but low NPV standard deviation 50. Right. So again, we're going to use Black-Scholes model figure D1, D2, and D1, D2 call price equity, right? So then we know the total firm value with investment, and subtract call price, the equity value, we got market value of debt. So one thing you notice that when you invest, you have to update the total value of firm after investment. So you guys ready for another example? Capital budgeting examples. So I do have some hints, but you want to try on your own. So this is two application. One is merger acquisition, one is capital budgeting. So lastly, option is widely used in the executive compensation package. So the main purpose is to try to align interest of the shareholders managers. So managers typically are awarded with lots of options at the time. At the time they receive those options, basically most of them are the money means worthless. However, when they're doing well, stock price goes up, the call option will be in the money. So that's going to give them a lot of incentive. FASB historically allowed companies to record zero expense for grant at the money stock options. However, the economic value of the long-lived call option is enormous, especially if company doing well, right? So, and the option is worth less to the managers than they cost the company, so the manager can only exercise, they cannot resell their options, so they only benefit from the intrinsic value. Okay. So anyway, option is a very important component for the executive compensation package. A call option is also sometimes issued combined with other securities to reduce the yield. The difference between warrants and traditional call option. Warrants are generally very, very long term. Okay, option could expire in 1 week. They are written by the company. Exercise result in additional shares of outstanding. So exercise warrant will lead to the change shares outstanding, may have earning dilution effect. The strike is paid to the company and generate cash for the firm. Warrants can be detached from the original securities sold separately. Convertible bond can sometimes be converted into a number of the common stock at the option of the bondholders. The conversion price is effective price paid for the stock. Conversion ratio is the number of shares received when the bond is converted. The convertible bond will be worth at least as much as straight bond, or the conversion value, whichever is greater. Example, you have a 10% bond paid semi-annually, mature in 15 years. Face value 1,000, yet maturity on similar bond 9%. The bond is also convertible with a conversion price of 100. The stock is currently selling for 110. So what's the minimum price of the bond? So the bond has this convertible features. According to conversion price, the conversion is 1 bond converted to 10 stocks. The stock right now is 110. So the 10 stock was 1,100. Based on just the inputs for the bond feature alone, the bond should sell at 1081, but due to the convertibility, they bring price to a bit higher. So the minimum price should be based on this one, 1,100. There's a lot of fancy security callable bond, the puttable bond, insurance, and the loan guarantees. So this chapter go over basic option terms, option quotes, and 3 type of option valuation called Parity, Schole, Binomial, 2 application in corporate finance, merger acquisitions, capital budgeting decision, and lastly some other features such as warrants and so on. So that's all for today.